Welcome back. In the previous video, you learned the real story behind secondary market annuities and why Wall Street firms spend hundreds of millions buying these payment streams. Today, I want to show you exactly how this works using an analogy that makes perfect sense, and then address the most important question: how do I know these are actually safe? Because let's be honest, when something offers a higher yield than a traditional alternative, your first thought should be, what's the catch? That's exactly what smart investors should think. So let me use this analogy. Imagine you walk into a Toyota dealership and you see a brand new Camry with a sticker price of $30,000. Right next to it is another Camry. Same model year, same features, same Toyota reliability and warranty, but this one's got 500 miles on it. Someone bought it, drove it home, and then they had to sell it because their situation changed. What's the second car worth? Not 30,000, maybe 27, 28,000. Same manufacturer, same reliability, same warranty, just used. So you get it at a discount. That's exactly what's happening with secondary market annuities. So let me show you with some real numbers in today's market. If you wanted to buy a new 20-year annuity from Prudential paying $1,000 a month, it would cost you $152,984 and yield roughly 4.9%. I can show you a secondary market payment stream from Prudential, same company, same A rating, same $1,000 a month payment for 20 years. It would cost about $141,384 and yield 6%. Same insurance company, same guarantees, same payment schedule. The difference? You save $11,599. You get a 1.1% higher yield. You're buying existing payments instead of new ones. That's all there is to it. So now you might be wondering, why would someone sell $240,000 in future payments for $141,000? Well, life happens. When it does, people value present-day cash more than future payments. Let me tell you about Mary. Not a real name, but a real situation I've handled. Mary was a teacher who got hit by a truck, received a structured settlement with payments of $2,000 a month for 25 years. 10 years later, Mary wanted to buy a house. She needed $80,000 for a down payment, and she needed it now, not spread out over 15 years. Banks don't give mortgages on structured settlement income, but Mary could petition a court to sell some of her future payments for cash today. Mary sold $150,000 in future payments for $80,000 in cash. She got her house, and you could have bought those payments and received that $150,000 over time, guaranteed by the same A-rated insurance company. This isn't just a handshake deal between Mary and you. Every transfer goes through a rigorous court process. Mary's got to petition the court. A judge has to review everything, her financial situation, whether the sale is in her best interest, whether she understands what she's doing. The judge makes specific findings required by federal law and in compliance with state regulations in every state to comply with IRS Statute 5891. This makes sure everything is complete and legitimate and compliant. Only then does the judge issue the final, unappealable court order transferring those payments. The insurance company is a party to these court transactions. They receive legal notice, and they acknowledge the transfer. And from that point forward, you can own those payments, just as if you had been the original recipient. Here's what should tell you everything about my confidence in this market. I've got $15 million of operating capital in my business invested in these same payment streams. I buy every single one of these payment streams before offering it to clients. If I wouldn't own it myself, I won't sell it to you. In 14 years of doing this, I have never had a payment missed, never had a customer lose money. The biggest crisis we deal with, payments get lost in the mail sometimes, and we have to request a stop payment and reissue from the insurance company. That's about as exciting as it gets. So let's talk about who's actually making these payments. This is not a promise to pay from Mary. We're dealing with existing in-force annuity contracts from companies like MetLife, Berkshire Hathaway, Prudential, New York Life. These companies have been around for centuries and manage trillions of dollars in assets. These are the same A-rated insurance companies that back traditional annuities. The financial strength hasn't changed just because the payment stream changes hands. If MetLife was strong enough for someone to use them for their structured settlement 15 years ago, they are strong enough to keep making those same payments today. Here's something that surprises people. The insurance company doesn't really care who receives the payment. From Prudential's perspective, they set aside money 15 years ago to make these payments. They received the premium a long time ago. The money's already reserved, already invested, and already earning returns for them and being paid out. So whether the checks go to Mary or to you makes no difference to Prudential. They're making the same payments they were always obligated to make. The insurance company's obligation doesn't change. The payment amount doesn't change. The payment schedule doesn't change. Only the recipient changes. Now, I believe in complete transparency in these transactions. And that's why before you send even a penny on a transaction, I'll send you the full collateral file documenting all of the transfer. Every transaction comes with complete legal documentation, which includes the structured settlement agreement or the annuity policy, benefits letters confirming the payments. Then we can go through the court order approving the transfer, an insurance company acknowledgement and stipulation agreements that are related to the transfer. We also have legal opinions from attorneys who have reviewed the transaction from start to finish. This is the complete chain of title, if you will. You can verify everything, download it, have your own attorney review it, all before you pay for it. I encourage that level of due diligence. I want my customers to know exactly what they're getting. Now, some people ask about risks. I'm not going to tell you there's zero risk. Every investment has some risk. But the biggest risk that I see, honestly, is what if the insurance company fails? We're talking about MetLife, Berkshire Hathaway, top-tier companies like that. And frankly, if they're failing, you've got bigger problems than just your annuity payments. But it's a reality that you need to face. So that's why we really only deal with the top A-rated insurance companies. Another risk is inflation. Your payments are typically fixed unless you buy streams with cost of living adjustments that step up. Inflation is not something we can really control, though. Many clients buy payment streams that step up over time, or they'll buy deferred income in addition to their immediate income streams in order to create layers of income that increase over time to maintain their purchasing power. The main risk that some people have is liquidity. These are not as liquid as stocks or CDs, but that's kind of the trade-off you get for getting higher guaranteed yields. The point is, these are known manageable risks, and they're not hidden surprises. Let's put this in perspective and compare them to other investments. Bonds? Well, bonds can fluctuate with interest rates, and they can default. That can be a concentrated risk on a single company oftentimes. Stocks? Well, we all know that roller coaster. New issue annuities? Sometimes you have the same high-quality insurance companies, but you're paying retail prices, and you're coming oftentimes with a lot of fees, caps, participation rates, riders, and other confusing terms. Bank CDs? Yeah, you have FDIC protection, but you're barely beating inflation. And in a falling rate environment, CDs will be going down fast. Secondary market annuities give you the safety of the insurance company guarantee, the legal protection of court orders, and yields that actually make sense in this environment. These are like annuities for smart people. All the benefits you want without the complexity and opaque terms and fuzzy math of new issue annuities. Here's what I really love about this business. This math, it's completely transparent. Every payment stream on our website comes with a complete payment schedule that you can click and download it and check it with any financial calculator and verify the internal rate of return. The yield is shown right on the web page, right on the schedule. And here's how you do it. First, you just go to the inventory page, and you can see that in this green button here. Then you can click the green button next to any case. Click to download the payments table, and you can check the math. You can use our online calculator here on the website, or you can use any financial calculator in the world. You'll get the same results. Try doing that with an indexed annuity. Try understanding exactly how your returns are calculated with a participation rate and a cap and a roll-up rate and a bonus rate and a payout rate. Good luck. With secondary market annuities, what you see is what you get. No projections, no what-ifs, just guaranteed payments using math that's been around for centuries. So really, that's the second-hand advantage. Why these payment streams are safer than most investments. Same manufacturer, same reliability, same payments, just at a discount because you're buying existing payments instead of new ones. Now, next up, I'm going to share with you some real customer success stories. You'll meet people like Dan, who went from being skeptical to investing over $1 million, and Brett, who's using these to retire early. These aren't theoretical examples. These are real people with real results who've given me permission to share some of their stories. So thanks for watching, and I'll see you in the next video.